Hello everyone, I'm Darren. Welcome to my channel. This week marks the first trading week of 2026. Looking back at the past year, US stocks continued to perform strongly. Although the much anticipated Santa Claus rally didn't materialize at year-end, the S&P 500 still rose by 17% for the year. This makes it the third consecutive year of annual gains exceeding 15%, which is extremely rare in US market history. So, as we step into a brand new year, how should we continue investing in US stocks? Will 2026 offer more upside? And what can we do to keep earning solid returns? In this video, I'll walk you through a systematic approach to investing in US stocks in 2026, aiming to outperform the S&P 500 with a more rational strategy. The video will be divided into 5 parts. First, we'll look at the potential overall trend for US stocks in 2026, what factors still support the market, and what risks we need to watch. Second, I'll share how to structure your portfolio more effectively to balance risk and return. Third, we'll go over common mistakes investors make when trading US stocks and how to avoid them. Fourth, we'll discuss how to use options strategically to boost returns without significantly increasing risk. Finally, I'll share several ETF portfolio ideas that I believe are well suited for 2026. This video is packed with insights and practical tips. My goal is to help you invest in US stocks more confidently and rationally in 2026, so you can aim to beat the market while keeping risk under control. My channel is all about helping you invest in US stocks more easily and confidently while keeping risk under control. I focus mainly on ETF investing, especially covered call ETFs, and my content covers both the US and Canadian markets. If you enjoy this kind of content, please take a second to like this video and subscribe to my channel. It really helps the YouTube algorithm recommend my videos to more investors. Now, without further ado, let's jump right back into today's topic. In the first part of today's video, let's talk about my outlook for US stocks in 2026. Looking back at the past few years, the market has delivered an incredibly strong performance. So now the big question is, can US stocks keep climbing while we manage risk? My overall view is cautiously bullish. I don't think this will be a smooth one-way rally, but from a broader perspective, the market still has solid conditions to move higher. The reasons behind my optimism come down to 3 key factors. First, the rate cut cycle has already started. The Federal Reserve is shifting its focus from inflation to economic growth and employment. As long as the economy doesn't spiral out of control and interest rates continue to trend lower, that's a strong tailwind for equities. Recent Fed statements and meeting minutes show a clear dovish tone, and the incoming Fed chair is expected to lean dovish as well. All of this is a long-term positive for the market. Second, the US economy remains resilient. Employment data is a bit soft, but GDP growth is steady. When the macro environment is stable, the risk of a systemic market crash is very low. Here's an important data point. Over the past 20 years, during rate cut cycles with stable economic conditions, US stocks have delivered average returns of around 15%. In contrast, when cuts were forced by a recession, markets typically fell sharply. For 2026, I believe we're looking at a stable growth easing cycle. Third, and most importantly, tech giants are now making real money from AI. This isn't just hype anymore. It's showing up in earnings and cash flow. That's a fundamental difference compared to previous story-driven rallies. Of course, this year is not without risks. The 2026 midterm elections combined with a Fed leadership change could amplify short-term volatility. AI-related sectors, given their high expectations, may see temporary pullbacks. And global macro and geopolitical uncertainties remain. Venezuela, Ukraine, Taiwan, China, and other political risks in certain regions. These factors may not change the long-term trend, but with valuations already high, any unexpected event could trigger short-term shocks. So in my view, 2026 looks like a volatile bull market. Opportunities are there, but success will depend on timing and risk management more than ever. In this uncertain market environment, how should we invest in US stocks in 2026? In this part of the video, I want to focus on portfolio construction. If you mainly invest in individual stocks, my first piece of advice is this. As we enter 2026, take a hard look at your portfolio structure, not just your returns. A good starting point is to estimate your portfolio's overall beta, which measures volatility. Stocks like Tesla, Robinhood, and Nebius, they all have very high betas that are above 3. That means if the market drops 1%, these stocks could fall 3% or more. So my view is simple. Understand these high beta names thoroughly and make sure you truly believe in them. When their prices come under pressure, you should be ready to add, not panic and sell. At the same time, keep their weight under control, so one or two volatile stocks don't blow up your entire portfolio. Meanwhile, I recommend making the core of your portfolio large cap companies with lower betas, strong cash flow, and proven business models, names like Google, Amazon, and Meta. Their biggest advantage is resilience. Even during major market pullbacks or extended bear cycles, these companies can keep generating cash and are unlikely to be wiped out. They act as stabilizers in your portfolio. In my own portfolio, I also include some mid-cap stocks with higher risk but higher potential returns, companies like Hims, Oscar, and BMNR. For me, these are long-term plays for growth, but they do carry much more uncertainty than large caps. That's why I always keep their positions small. They can deliver big gains, but they can also cause big drawdowns. If you don't have strong conviction, and you're just hoping for a quick profit, honestly, you don't need to invest in these mid-cap names. Even if your portfolio is mostly individual stocks, I suggest adding some ETFs that track the broad market. ETFs help reduce volatility and give you flexibility when the market pulls back. They allow you to rotate into cash and buy quality stocks at lower prices. In my own portfolio, I always keep about 10% in an S&P 500 ETF, for example VOO or SPYM. The goal is to make the portfolio more stable and keep some dry powder ready for opportunities. If you're interested in ETFs, make sure to watch until the end. I'll share my ETF portfolio ideas for 2026. In the third part of this video, I want to talk about several major pitfalls that I believe investors should try to avoid when investing in US stocks in 2026. The first one, and in my view the most important one, is emotional trading. Over the past year, through conversations with many individual investors, I've noticed a very common pattern. Many investment decisions are heavily driven by emotions. In some cases, people end up making the same mistakes repeatedly on the same stock. When prices move sharply, emotions often take control, and rational thinking takes a back seat. Last April's market sell-off is a good example. At that time, I personally started adding positions gradually in early April. That decision helped me achieve solid returns in the months that followed. However, many investors chose to sell at the point when fear was at its peak. As a result, they not only missed the rebound, but their full-year performance ended up underperforming the S&P 500. This kind of behavior shows up repeatedly in popular stocks. When Tesla fell to around $200, almost no one was interested. But after the stock rallied all the way to $480, the narrative suddenly shifted to, "This is a must-buy." Nvidia followed a very similar path. When its stock dropped to around $90, many people believed the company was finished and that the semiconductor industry would be overtaken structurally. Yet after strong quarterly earnings pushed the stock to $200, investors rushed back in, convinced that the stock was still undervalued. Behind all of this is a very typical psychological illusion. When a stock is falling, it often feels like there is no bottom. The lower it goes, the stronger the fear becomes. On the other hand, when a stock keeps rising, a different kind of anxiety appears, the fear of missing out. People start worrying that if they don't buy now, they will never get another chance. The core advice I want to emphasize here is actually very simple. Only hold stocks that you truly understand and genuinely believe in. When your conviction is strong enough, you are much more capable of distinguishing short-term market noise from real changes in fundamentals. Another point that I think is extremely important is this: never exit the market completely without a very strong reason. Even when the market keeps falling, even when overall sentiment is extremely pessimistic, fully liquidating your positions often leads to the worst outcomes. There is a well-known saying in investing: time in the market beats timing the market. Instead of trying to precisely predict market tops and bottoms, staying invested over the long term usually leads to better results. The US stock market itself has a long-term upward trend. Even after extended drawdowns, history shows that it has repeatedly returned to new highs. If you allow emotions to take over during downturns and decide to exit completely, you may end up selling at or near the bottom, giving up all the subsequent recovery. Of course, when I talk about assets that can recover after prolonged declines, I am mainly referring to high-quality companies, or broad market ETFs. For speculative small-cap stocks, especially meme stocks heavily driven by retail sentiment, my advice for 2026 is to stay away from them. Examples include GameStop, AMC, Beyond Meat, and LivePerson, among many others. Personally, I have never invested in any of these meme stocks. However, I do have friends who actively trade them, so I've followed their performance closely. Their results in 2025 were frankly disastrous. GameStop fell about 35%, AMC dropped around 60%, Beyond Meat declined roughly 77%, and LivePerson fell more than 80%. My view on these meme stocks is straightforward. They are essentially a form of speculation, or even gambling. They are driven by retail sentiment rather than fundamentals. While some people may make significant money in a short period of time, once sentiment fades, prices tend to collapse. The higher they climb, the harder they fall. In my opinion, GameStop is worth no more than $10. As for LivePerson, without a meaningful competitive moat or a fundamental turnaround, the end result is likely bankruptcy or delisting. The US stock market offers no shortage of high-quality blue-chip and growth companies. There is simply no reason to allocate any part of a long-term investment portfolio to meme stocks. In the fourth part, let's talk about how to use options more flexibly for risk management and to enhance returns. If you're holding a stock that has run above the upper Bollinger Band and you expect a short-term pullback and you don't mind selling at least 100 shares, you can consider selling a covered call to collect some premium income. Even if the stock goes sideways or pulls back, selling covered calls can help offset losses and lower your cost basis. Similarly, if you're bullish on a stock long-term and want to buy at a lower price, you can sell a cash-secured put. That allows you to collect premium upfront while giving yourself the opportunity to buy the stock at a discount. In my view, both covered calls and cash-secured puts are relatively low-risk option strategies when used properly. And if you change your mind as expiration approaches and don't want to buy or sell the shares, you can always roll the position forward to continue collecting premium without taking assignment. If you're very bearish on US stocks in 2026, you can use in-the-money covered calls for downside protection. For example, if Nvidia is trading at $190 and you're worried about a major pullback, you could sell a $150 call expiring at the end of 2026. That trade could generate over $7,000 in premium right away. If the stock falls below $150, the option expires worthless, and the premium offsets your stock losses. If the stock stays flat or rises modestly, you still come out ahead because of the premium. The trade-off is that you give up upside if Nvidia rallies sharply above $220. This strategy works well for more conservative investors who want to reduce downside risk while locking in meaningful income, even if it means sacrificing some upside. Besides selling options, you can also buy options to pursue higher returns, as long as you're willing to take on more risk. For stocks you're very bullish on long-term, I like buying Leaps call options, especially when the price is near the lower Bollinger Band. For example, when Nvidia dropped to around $170 in September, I bought a January 2027 $185 Leaps. Within a few weeks, the stock recovered to $185, and I closed the position for a solid gain. I've used similar trades on Robinhood and SoFi with good results. The biggest risk of buying calls is time decay, and leaps help reduce that risk by giving the trade more time to work. That's why I only buy leaps on stocks I'm extremely confident in long term. Leaps can generate even bigger gains on small cap stocks, but the risk is much higher. I'm currently holding a BMNR January 2027 leaps that's deeply underwater, and that's been one of my biggest lessons in options trading. As for put options, I generally don't recommend buying them unless you have a very large portfolio and are using them purely for protection. Betting on downside in a long-term bull market is difficult, timing is unforgiving, and the margin for error is extremely small. In the final part of the video, I want to talk about ETF portfolios. I'm sharing the specific portfolio breakdown here. If you're interested, please leave comments below, and I will post more future videos to explain these ETFs in more details. If you feel individual stocks are too volatile, especially when a single name can drop 10% or even 20% in a day, then building a portfolio with ETFs can be a very solid alternative. Compared to individual stocks, ETFs naturally diversify risk and significantly reduce emotional stress during the investment process. From my own experience, the biggest advantage of an ETF portfolio isn't just the return, but the holding experience. My ETF portfolio returned about 30% in 2025. While that didn't beat my stock portfolio's 45%, it still outperformed the broader market, and the process was much easier. I didn't have to worry about any single stock blowing up or spend hours researching individual names. I just managed overall exposure and rebalanced periodically. So if your risk tolerance isn't very high, or you don't want to be glued to the screen every day reacting to market noise, an ETF-based portfolio is often a better fit. 2026 is unlikely to be a year where aggressive trading wins easily. Instead, it will reward solid portfolio construction, risk control, and long-term patience. Simply staying in the market over time is already a major advantage. That's everything for today's video. I hope this deep dive was helpful and gives you a clearer framework for investing in US stocks in 2026. If you found the content useful, please remember to like the video and subscribe to the channel. This is the first episode on the channel, and going forward, I'll be regularly sharing stocks, ETFs, and covered call ETFs in both the US and Canadian markets that I think are worth paying attention to. I wish everyone a strong 2026, hopefully outperforming the market and continuing to grow your portfolio. Thanks so much for your support, and I'll see you in the next video.